What's going on, option traders? Hopefully soon to be option traders. My name is Bo Crable, and today's video I want to talk about break-even points. A generally pretty boring topic, but it's super important for the fundamentals of trading options. Now, if you've came to this video to learn some concepts or just to learn the boring math, I have it all in store for you. In this video, I'm going to talk about, first off, what is a break-even point and how to actually calculate them. And then most importantly, the second thing I'm going to talk about is how you can use break-even point as kind of a rule of thumb to figure out your risk versus reward, your probability, and kind of how much you can make or lose. And then the last thing I'm going to go over is how you can do all this automatically. So you're not going to have to do all these calculations in your head or do it in Excel. I'm the founder of Option Scout. And at Option Scout, we have a completely free tool that helps you with this. There's no tricks, no gimmicks. There's not even ads on it or anything. You can just use the tool and do this for you. And there's also a really cool thing that we've done where you can visualize it. And actually, what I'm going to be showing you is not currently live on the site as I'm filming this video. But as you are watching this, you can go to the links down below and you can see it, because by the time I post this, this will actually be live. So what I'll be showing you is in development mode. But first off, let's just kind of get to the boring definitions and the math, and then we can kind of go on to more of the concepts and the cool automatic way to do this. So first off, if selling and buying actually doesn't usually affect, or it does not affect the break-even points for single leg strategies. So if you are buying a call option and selling a call option, your break-even point is actually the same. So for calls, if you are selling a call, or just calls in general, your break-even point is the strike price plus the option premium. So for example, let's say stock XYZ is trading at $150 and you sell a naked call at $160, and for that you collected $1 in premium. Okay, so now what your break-even point is the strike price plus 1. So 160 plus 1 is 161. So if the stock goes all the way up to 160, you're still in the profit, but then after that, you start to lose money. For buying calls, it's not the inverse. It's just that once you get to that point, then you're in the profit. And everything before that, you're at a loss. And for naked calls, everything before that, you're at a profit. For puts, it's the inverse, where it is the strike price minus the premium paid. Now, the only thing that gets different, because if you're trading covered calls, or if you're doing like a covered strangle, or you're doing a reverse covered call, or sometimes referred to as a covered put, it's different. When you're owning stock, or if you're shorting stock, the break-evens get to be different. So let me finish off the put example. If you are trading a stock that's trading at 150 and you sell a put at 140, and let's say you collected $2 in premium, your break-even point is 138. So now let's get into options where you own equity, covered calls, covered strangles, etc. So in the first example, where you sell a call at 160, your break-even is 161. Let's say you did a covered call in that situation, so you own the stock. Now it's way different, because if you're a stock trader, and this is why stock traders don't really care about break-even points. It's not really referred to. Your break-even point is what you just bought at. It's your buy cost. So the formula for a covered call, or equity in this case, is going to be your buy cost minus the premium. So if you're doing a covered strangle, or if you're doing a reverse covered put, well, actually, okay, if you're doing a covered put, it's the reverse, it's plus the premium, with the situation at hand. But yeah, so for covered call, let's say stock's trading at 150, you collect $1 in premium, strike price is 160, your break even is 149 because you own the stock. So if the stock goes down, you can still be losing money compared to a naked call. You're not doing anything at all. All right, so that is it. So now let me explain to you kind of some cool concepts and principles to know. So with puts, this is something you want to remember. Lower the break even, lower the risk. And for calls, it's the reverse. Higher the break even means lower the risk and probably lower return. So remember that. And this is important to understand, because what I like to do for break-evens is I like to say, okay, this is my strategy. I think the stock is going to the moon, or I think the stock is going down, or I think it's going to stay here. I like to be like, okay, that's what I think. So let me formulate and put a strategy that I think is going to work. And then instead of me being like, that's what I'm going to stick with, I want to look at the numbers. And the first number I'm going to look at is the break-even point. Because if you are, let's say you want to do a leap, you want to do a very long-dated, maybe in the money or out of the money call option, that's a very bullish bet. And this is super important to understand because, depending when you're buying it, the expiration, the implied volatility, you could be absolutely correct on the direction, but you still could be at a loss because maybe your break-even point is just so high. So, if you're an option buyer, look at the price you're buying it at and then look at the break-even and then ask yourself, do I think that's going to happen? Do I think the price is going to get to that break-even point? Do I? If you're a buyer. Now, if you're a seller, you also need to ask yourself that as well. It's like, okay, do I think it'll get to that point? Because now if it gets to that point, if you're selling a cash secured put and say your break even's 138 because you sold a 140 strike, stock is currently at 150, you have to ask yourself, okay, will it get to 138? And if you're like, okay, of course not, then maybe you up your risk, okay? Or maybe you're like, oh yeah, probably will, then maybe I lower my risk, okay? So that's how you want to think of it. It's kind of like an anchor. Think as an anchor towards your strategy. So now what I'm going to do, I'm going to go on my computer and show you a few strategies and how you can automatically do this yourself. So you can kind of, if you want, you can throw away these math formulas if you want to, because you can just use our software completely for free to do this for you and it'll give you a really nice way to visualize this. Or just remember those formulas and it will help you on your journey. All right, so let's get into this. There's going to be 3 strategies I'm going to show you. One's covered call, 2 is naked put, and 3 is iron condor. Now, again, if you go to optionscout.com and use the option profit calculator, it's going to look different than this. It's also going to look a lot better. This is, again, just like development mode and stuff like that. We're testing a few things, and so things are going to be a little bit different than what you use it as. But I'm choosing these 3 strategies for a few reasons. Covered call is you're owning the stock and selling a call. So that's going to change up your break-even points. Iron condor, I'm choosing to do this because you're going to have 2 break-even points. I want to show you how you can visualize this, and naked put is inverse of the calls. So let's pick up Apple stock here, and let's find a strategy here to do this. And again, once you do this, and again, it's going to look a little bit nicer when you play around with it. It's going to calculate the break-even point for you automatically, and then you can visualize it. So, okay, this is a covered call. So if we do 165, what is our break-even point? Well, if it's a call, that means you need to add the option price from the strike price, but you'd be wrong for that because this is a covered call. So since it's a covered call, you're owning the stock, you need to do the stock price minus the premium you received. So that's going to be not 165 minus the premium, it's going to be the stock price minus this 163, 162. And then here we give you a really nice way to show that. So you can see roughly, it seems like the break even is between 155 and 156, which we'll show you right here. It's 155.74 is the break even. And then now you can see with this covered call is you can see, okay, if you're up here, you're going to be in the profit zone. And then here, boom, you hit your max profit. And you can see with the covered call, technically your max profit can be, or max loss can be a lot. So once you get here and above, you're making $926. Doesn't matter if Apple goes to $1,000 or more. That's how much you're making. And this is your break even point. So the cool thing with covered calls, it's technically less risky than buying the stock. Like, think about this. Your break-even point is here, 156. The stock price right now is 157. So if the stock doesn't move, you're in the money. Your profit. Boom. Great. Now let's go to naked. Actually, no, let's go iron condor next because I want to show you this and how you can play around with 2 different break-even points. So let's open this up. Okay. Now, all right, so with an iron condor to be an iron condor, you need to be doing one of everything. You need to be writing a call, writing a put, buying a put, and buying a call. And to make it like a normal iron condor, they all need to be even from each other. So the long call and long put need to be the same distance from at the money, and same with the right ones. So let's actually start off by buying a call. So we want to be in the money, and let's actually go pretty deep in the money, and let's do it $40 in the money, because right now Tesla's like at 300 even. All right, so then now let's buy a put, and let's go again $40 in the money, which is going to be 340, and then now let's switch to writing a put, and let's do $20 in the money, which is going to be, or $20 out of the money, which is going to be 280, and then let's write a call. Again, $20 out of the money, which is going to be 320. Okay, and then now this should make a even looking situation. Yeah, so you can see it's kind of like even. Let me explain what's going on. Your break-even points are here and here. and your max potential is here. So your max profit is going to be between these range, and your max loss is going to be between here and down, and here and down. So an iron condor has a limited profit, a limited loss, and 2 break-even points. So you can see here your first break-even point, and this is referred to as your downwards or your downside break-even. It's going to be roughly 271, and then your upside break-even is going to be roughly 328 or so. And your max profit in this case is 875, and max loss 1125 on both sides. So now if you play around with the calculator and you choose different prices and stuff like that, it's going to affect the break-evens and also the max profits and gains and loss. So now let's go to naked put. Let's go back to Apple stock. And here I want to see if you can get this right. So I'm going to open up the options chain. If you can wonder why it doesn't open up right away, it's because, again, I'm in development mode with other things going on. But anyhow, it's going to be a lot easier to use when you go on the website yourself. So anyhow, let's make this simple. Let's go down and let's click on this. So right now, Apple is at 157. So this is out of the money. And if we're doing a put, we know that a put is what? I'll let you pause, maybe you can understand. It is the break-even point. Okay, so now here's a little bit of test for you. Let's figure out this break-even point, and hopefully I can do it without telling you. So remember, the formula for a break-even point for a put option is the strike price minus, you can pause to see if you're right, minus the option price. So in this case, it's going to be 142 roughly, something like that. So if you click on this, it should be roughly 142. Yeah, it's exact 142. So here, you're making money as long as it goes down there. Now, if you want to adjust it, you could just, figure out that, and so here your break-even point is going to be higher, it can be higher, which for puts is more risk but more return. So here you can see you're getting $1.26 in premium in exchange for you're going to have a higher break-even point, which is going to be roughly at the 144 mark. So yeah, that's kind of everything you need to know about break-even points. So again, to recap this video, I wanted to show you how you can automatically calculate it, which is this. You can do it with a tool. You can go to optionscout.com, check it out. But more importantly, you need to understand break-even points if you're buying options or trading options, selling, whatever you're doing. Because as an option buyer, once you hit that break-even point, everything after that is profit. If you're doing like a strategy, like a short put spread, any type of credit spread or vertical spreads, you want to understand that. Just because you can understand how bullish or bearish you are, or what can happen. Because then what you can do, you'd be like, you know what, I want to do the strategy, and then think to yourself, okay, do I think it's realistic for the stock to get to that point? And if the answer is no, then you probably shouldn't be trading that option, because it's like, if you don't believe it can get that break-even point, then you're not breaking even. So that's about it. I will see you in the next video. If you like this, make sure to smash the like button and subscribe. If you want to utilize our free software, go check it out, and I will see you in the next video.